Welcome back, best ever audience. Joining us today is Justin Spillers. He is a former corporate and real estate attorney and the co-founder of Real Estate Alpha, as well as Christian Leone. Justin has built a vertically integrated portfolio over 850 units, generating over $800,000 in monthly cash flow across Ohio. And even better, he's maintained a 95% plus occupancy rate through every market cycle, paying every single investor on time for 10 consecutive years. Today, he is going to share the exact red flags passive investors miss and show you how owning every layer of operations keeps investors paid when markets turn. To learn more about their systems, you can check out realestatealpha.io. With that, Justin, Christian, the floor is yours.
Thanks so much, AJ, for that intro. Appreciate it. Thanks a lot, Christian, as well. He is a capital raising manager for us in-house. He's going to help with some of the Q&A and chime in throughout the presentation. But these are kind of the key takeaways from what I'm hoping you get out of this webinar today. Really, the big questions you should be asking about investment opportunities before you invest, giving you somewhat of a reusable checklist. These non-negotiable questions you can always ask of the GPs, the operators, before you invest. A way to stress test that risk with some of these fundamental questions. And then the yield mechanics and fully understanding how those compare to other deals and opportunities. So apple to apple comparison is at your disposal. But why listen to us, right? I mean, what's the credibility behind what we're about to say? Basically, we have a decade of experience. Myself and Brandon Vergalito, we're 50-50 business partners. We invest in Western Ohio. We both have bought and sold a tremendous amount of real estate in a lot of different spaces, commercial, triple net lease, residential, etc. All we do now is value add multifamily real estate in Western Ohio. Some big picture numbers. We have over 850 apartments. We have 3 more deals under contract. We'll be at about 1,100 apartments come August. We'll eclipse $1 million of rents per month at that time. Stabilized rents for occupancy, we're always targeting 99%. We have a very different leasing model than most, which I'll touch on later. And then again, that 10-year track record. We've brought everything in-house. We're fully vertically integrated. We have a team of about 50, climbing very fast. Again, doing everything from acquisitions, leasing, maintenance, property management, construction, capital raising, all done with our own team. So how have kind of historically passive investors got burned? Some of the bigger things that you're seeing unfold right now is when GPs start to pause distributions, you get the fund capital call email. And this is mostly because people were chasing IRR. They weren't looking at fundamentals. And they weren't truly understanding what operator they're betting on, right? They're chasing the next shiny market. And a lot of those things are very different than what we do on the value add side and how we analyze and look at deals. And I'm hoping these patterns you'll start to recognize, and we'll hit on some of these lessons throughout the presentation. But really, the fundamental framework of the checklist I'm going to give you all comes back to the operations of the investment of the operator and who's in charge of it. It's not asked very well and definitely not into the depth I'm about to really give it to you. A lot of the syndications, when I was a real estate attorney, I used to help my clients build syndications. I've done 506(b)(c)s, crowd raising, all different types. I've seen every structure under the sun, hundreds of different models. And they're great, right? There's a lot of good opportunities out there. There's a lot of good operators out there. But the one thing that I see consistently across the board is the operators that can weather the storms have full control over the operations. And in most times, it's fully in-house. Doesn't mean you have to have it all in-house, but the ones that typically weather the storm have it in-house and they have full control over the entire ecosystem of that investment or that fund, depending upon what it is. So that is what I want to really, really stress on today. And why a vertically integrated means a different thing to one investor than others. So on our side, for example, we truly do it all in-house. We outsource nothing. Some people say that and they just do property management and they don't do leasing or maintenance. Some people do just maintenance and property management. They don't do their own renovations. There's kind of a different spectrum of vertically integrated. You can have a little bit in-house or you can have a lot in-house. So we have a lot. And for a lot of different reasons, which I'll get into here, we've brought everything in-house. But just to give you an example, flavoring of how we operate and how that allows us to have more control over the investment. And these are the questions therefore you should be asking your operators or your GPs before you invest, is on the acquisition side. How did they find the deal? That's super important. That's 50% of the value is buying right and understanding how the deal was sourced and found. We have an entire acquisitions team. I have an acquisitions manager. We have 3 analysts. We've been building this flywheel out for 10 years. So we have our own proprietary database. It's about 23,000 Ohio properties. The beauty of what I do of value add is you can't build an old property, right? The total addressable market, the TAM we have of existing properties is known, right? There's no new ones. I don't buy anything unless it's at least 10 years old. So I know exactly what my total addressable market is. We have that in a database. We've combed every paid one possible, Crexi, Reonomy, etc. Those are a great starting point. We've pulled all the data, put it in ours, and we underwrite every deal we see. So every single property gets a deal number and it's associated with the address, and then we weight it based upon our buy box. Those online companies, Crexi, Reonomy, only about 50% of the data is updated, is what we found. The other 50% is incorrect. And so we hunt that other 50%. Meaning, if you go in Crexi, Reonomy, you find a really good property, it lists the owner, the owner's information's wrong, it's either outdated, wrong email, wrong phone number, etc. Those people aren't getting hit by anybody because nobody takes it the next step. So what my team does is we have an entire AI system for underwriting and finding the correct information. So we look at all 88 county offices, all 88 county recorder's offices, all 88 county courthouses for eviction data. We look at all the Secretary of State information. Everywhere possible where that ownership information could lie, we find it and we hunt it and we update our records and we make sure that the data is valid. So when we find that right information of the other 50%, there's nobody else sending them direct letters. There's nobody else cold calling them because they're not on the online databases everybody uses. So having the acquisition side, that flywheel build is super important. And so we go direct to owner as much as we can. And that is a sheer effort follow-up system. We call them religiously. We send them gifts. We send them bottles of wine. We send them direct mail mailers. We send them direct video mailers, a little LCD screen that plays information about us. We network with them. We're constantly in front of them because it's all about right time, right place. So we typically have to hit an owner 40 to 60 times before they're willing and ready to sell. And it's always someone died, their business partner dispute just came to a boiling point, someone got divorced, right? And you need to be in front of them at that right time, right place. The other 50% is from brokers. We have the same database with brokers in our area. We call them, text them, send them gifts. We want them to think about us. We make it extremely easy for the brokers to do deals with us. We do everything turnkey. We basically say, give us the opportunity and get out of our way, which they absolutely love. We put 1% hard money down, non-refundable. We underwrite quickly. We do everything in-house on the underwriting side in less than 7 days. We have a proven track record. We've never not closed. So a really attractive model for the brokers too. So we're hitting everybody for those deals. Once they come in, we underwrite it very ruthlessly. We are very principled underwriters. We underwrite about 100 deals per month. So about 1,200 per year. We're only looking to buy 3 or 4 per year. So we only try to find needle in a haystack deals. And so when you do that, and you send out a lot of offers, we're typically very low compared to others, or we're trying to create value before it hits the open market. We rarely ever buy something that's on the market. It's always off-market deals, either through a broker or direct to the owner, and that's where a ton of the value is created. That system is working really well. We just closed on 4 properties this year. We have another 3 under contract. All 7 have been sourced through that process. 6 of the 7 have all been off-market deals through either direct to seller or direct to broker deals we've worked on sometimes for 4 or 5 years now. So those questions of how did you find this deal is important. You just heard what we did. We only buy if the property in our mind considers to be a home run using our underwriting and buy box metrics. That's super important. We do that all in-house. We don't outsource any of that. I see those numbers every day. We have a weekly call to go through our entire funnel of how many pieces of content did we put out? How many people did we talk to? How many deals did we underwrite? How many offers did we send, right? We look at that entire funnel top to bottom. And then once we buy it, the leasing side, we do all of this in-house. Again, we treat this very different than most. And leasing is absolutely everything for the deal structure and having that cash flow mechanism to be able to pay you and then hit the back end exit, either refinance or sale numbers you're after in your investment thesis. On the leasing side, we treat it like a high ticket sales team. I have a sales manager. I have 5 in-house leasing managers. I have 6 setters. I have 1 application manager, and we do nothing but volume. We get over 200 leads per day. Our entire thesis is speed to lead. Those leads have to be called in less than 5 minutes and ideally in the first 60 seconds. If you call your leads within 60 seconds, you have a 400% close rate. So we call them, our setters call them, our leasing manager call them. If our setters get a live lead that pass our 4 screening criteria, which we are ruthless on, have to have a credit score over 550, can't have a prior eviction, can't have a prior felony, and you have to have 2.5 times income to rent, meaning if rent's 1,000, you have to make $2,500 after tax every month. You meet those 4, then you have to pass the smell test. The leasing manager has to truly believe you're not going to destroy the unit and you're going to pay rent. Then we can rent to you. But when the setters meet those qualifications, they literally tell the lead on the phone, hold on, and they send in our Slack channel, I have a lead who can do a showing right now. We've completely moved to at the property showings. We only do virtual showings now. It's actually converting better. It's way easier to handle from a leasing perspective for coordinating who needs to be where. And the volume just keeps increasing and our close rate gets better by shifting to virtual. It's very different. But back to that Slack channel. And the first leasing manager grabs it, they hop on, they do the showing right then and there, right? If you've ever seen the movie Boiler Room, it's like they yell, Rocco, I got a live lead, who can do it? And my virtual or my leasing manager jumps on a Google Meet with them, does a virtual showing just like this, and runs through our entire pitch. We have 100% script adherence. We record every single call. We run it through our Claude Cowork session. They get a full scorecard afterwards. They tell the leasing manager exactly where they went off script, how they could have handled the objections better. They get a score, they get a ranking. My sales manager trains them on it every single day. And our entire goal is to close that lead that day. So same day showing, same day close is everything we do. So application, we send it to them. We're on the call. We're vetting them. We do it with them. We make sure if anybody else needs to be in the decision making, we find out, hey, okay, your husband, when can he be available? Can we talk in an hour? Can we talk in 2 hours? How do we pull it forward? We don't let them set it for tomorrow or the next day. It's always same day. And there's a sense of urgency throughout everything. And that's how we treat all facets of our business. So on the leasing side, you can imagine we're taking in 200 leads per day across our portfolio. We get about 80 to 100 move-ins per month. That's another segment in the property management side, but it's high volume. We are ramming nothing but scarcity and urgency across our lead base constantly. We have lead nurturing, email sequences we send out, cold calling sequences, text messaging sequences, and that entire function is how we get leasing to be 99% or higher on our stabilized assets and even 95% in our mid value add turn assets. So that leasing questions, again, you can see what we do. Ask your GP and operators what they do. A lot of them outsource it to third-party property management companies. They're lucky to even call their leads back, right? They have someone sitting in the property and they take a walk in and they'll do a showing and it's kind of a matter of fact, we'll get back to you. I'll send my pay stubs tomorrow. None of that is for our team. It's all urgency. How do we do it quicker, faster, better? And we have the entire lead flow. So I can see the leasing, same funnel, right? How many leads come in? We have for every 100 leads, we have about 40 showings, 25 show up. We get about 20, 22 applications, 3 to 4 leases signed like clockwork, right? If we need to increase our vacancy or decrease our vacancy of some properties, I just increase the paid ads in the lead flow we have. We have about 22 lead sources. We can go out from paid to organic and we push that hard. So we know our numbers because we do it all in-house. It's super important. And then once we get to 100% stabilized, we pre-lease everything, right? We have a wait list at most of our stabilized properties. So we never have any downtime. So then going into property management, again, we do it all in-house. We have one culture, we have one standard. All of our property managers, we call them community managers. They float across all the properties. We do as much virtual as we can. We have about 4 or 5 virtual team members, mostly in the Philippines, that handle resident questions in real time. We have an SOP for everything. Questions get answered in 1 hour or less. Always within 24 hours is an issue resolved. We track that ruthlessly. That feeds into the maintenance and the work orders. All of our maintenance technicians, they go to the door, they're knocking, they're saying the resident's name, they're smiling, they're giving them a compliment, they're taking off their shoes, they're making sure it's followed up, and they have a clear directive afterwards. If it was completely resolved, if they need to come back, when they're going to come back, and we close out all work orders in 48 hours or less. We also do proactive quarterly inspections. We go into every single apartment, our team, and we're flagging anything that needs fixed, even if the resident doesn't put a work order in, and we're making sure that that resident's taking care of their unit and they're not having any lease violations. And so that just creates an environment where the expectation is you have to live in a property where everybody takes care of their unit, their apartment. And that's super important for us. There's always people on property, whether it's a community manager, one of our maintenance technicians, there's always people there. And it kind of all flows into that same white glove service offering we give our residents. And then the construction renovation side, again, all in-house. These are W-2 employees. The construction renovation side is about half of our team. Building this out has allowed us to create all the value much quicker. So most people do value adds in 3 to 4 years, meaning they turn the units slowly, they get them leased up, they stair step the rent increases. We've completely condensed that model. We do it all in 12 months or less. We're actually trying to build out our model so we can do a full turn in 6 months. So the way we do that is when we purchase a property in our PSA, we have two new things. One, we get to turn the vacant units during the hold period. So when we sign a purchase agreement to when we close in 75 days, all the units become vacant. We get to turn to our silver level finish to what we want to do. Why would the seller allow us to do that when we don't even own it? Because if we don't close, they get a brand new turned unit. They get all that money we put into the property back to them. Second, during that 75-day hold period, all the leases that lapse, the owner can only renew them from month to month. So that when we close 75 days later, about a third of the property is month to month. We're not locked into low rents, long-term leases. We can go in and have the hard conversations with all these residents. Let's say it's a 100-unit apartment complex. We'll have about 30, 35 meetings on the day we close. We'll already have a unit turned. We'll meet all 35 residences one by one, or sometimes we'll stack them together, create urgency in an already turned unit and say, these are your options. We'll pay you $1,000 to move out this weekend. You can stay in your existing unit at the same price for 3 months to find a new place to live. You can be non-renewed. This is your notice right now. We're not going to allow you to stay past next month. We'll give you your full deposit back. Or you can transfer from full market rate rent into a unit exactly like this that they're looking and seeing. And we're trying to transfer and keep as many residents as we can. And that's how we can turn it extremely fast. We then have three-man turn crews. We have all the three-man teams are the exact same. We have a crew chief, a Renotech 1, Renotech 2. We have every single part of our turn process standardized. All 88 SKUs across all turns, all properties, all unit types use the exact same SKU for bulk buying, ease of application. We've done time studies on every facet of it. We're trying to turn entire units in 7 days or less. So we work 10-hour shifts. We come completely prepared. We pre-kit everything. We bring it on site. No one has to run to get any of the inventory or SKU items. We paint at night, and we try to turn that entire unit in 7 days or less. So our entire goal is to turn and stabilize the entire property in 12 months. We're trending for less than 12 months now, and then that allows us to refinance, get our capital back, and move on to the next one extremely fast. Condensing that from 3 years to 12 months is just a massive return on your capital. And again, we can do that because we do all of it in-house. These are our team members. We manage them every day. We know exactly what the status is. We know exactly what the cost of everything is. We don't have to get approvals. And again, going back to the thesis of this, when you're vetting operators and GPs, who's doing the construction? How are they managing this? How quick do they do renovations? What's the priority and urgency of it, right? These are our team members. They get bonused on how fast and quickly they can turn a unit and a property. And we have full control and visibility of that. We don't have to wait 60 days to see if that third-party construction company is behind. I know every day the exact status of every turn. So by doing all that in-house, acquisition, leasing, property management, maintenance, I can see it all, right? Every morning I get a dashboard KPI update from all of my managers of each of those divisions that says exactly the current status of everything in real time. There's no delays, there's no missing information. And by doing that all in-house, we care much more about the outcomes, right? And we have that culture of speed, urgency, quality. And that's super important. I'm not saying you should only invest in operators and GPs that do all this in-house, but really press them on these questions. Have they ever used this property management company? Have they ever used this construction company? If so, what are the KPIs? How quickly can they execute on the value add side? If the CapEx budget's $1 million, what part of the interior is that going to? What part of the exterior? How many units are they turning? How quickly can they turn the units? And know answers to those questions. That's super important. If the GP and operators don't already have this mapped out by the time they're raising money, that's a huge red flag to me, right? And those operators and GPs that are just trying to make money on the fees, an acquisition fee, a disposition fee, a property management fee, those are the operators that have lost sight of what's important, which is the meat and potatoes of what I just went through. So this is our moat, right? We control every variable. We want to make sure we're the best in Ohio at turning C class property into B class faster than anybody. And we do that every single day by looking at what's our constraint in this business division. How do we make it better? How do we build on the foundation? And how do we do it in-house without outsourcing any part of our function to a third party company? So that is a high level of the types of questions you should be thinking about and what truly vertically integrated means. So I've probably hit on a lot of the slides I'm going to come up to. I thought it'd be valuable just to walk through all five in a row there. But I want to make sure I hit some of the things on the speed side. So when I say speed, I mean speed. Like on the leasing side, I track it. We are averaging a response to a lead is 7 minutes right now across the portfolio, all leads, and that's including after hour leads. So we staff our team after hours, weekends. If I'm looking for 8 to 5 leads, it's probably closer to 3 minutes. I'm pushing them every day. How do we get it to 60 seconds? That's the North Star, right? How do we reply to a lead that comes in within 60 seconds? Because these are all hot leads, right? These are people who've raised their hand saying, I'm interested in this property. So our entire weekly meeting is how do we go faster, right? Always, how do we go faster? How do we train on script adherence? How do we do it faster? And then on the cost side, same on the turn process. What SKUs can we go to? What has the best bang for our buck? We've tested every LVP possible. We're on one that's slight premium, but it's durable and it holds it for a long time, but we can install it twice as fast. So that's more important to us even than the cost because my labor cost on the install is more than the cost of the good. So we're constantly looking at that. What else is tripping us? Like outlets. We had different types of outlets that just take longer. We've flipped them all to the panel style. It's sleek, it's modern, it's elegant, it's easy. We only stock one type. We go and we change it out when we do renewals, or if we have to turn it again in the future, it's all the exact same thing. Um, no third party risk again, like no contractor showing up or saying, oh, my painters got sick or this guy went on vacation. We don't have to worry about that because we already have our entire capex schedule planned out. We know when our guys are going to go or our team members are going to go on vacation, and we have it scheduled and mapped out, and we can pull resources as needed. We have a south and a north team. South is closer to Dayton, Ohio, on the western side of Ohio. The north team's closer to Toledo, Ohio. If we get behind there, I can send my south team up to the north team, right? And help them get caught up. So we have a lot of flexibility by having no third party risk there. And then cut cost or survive. So when we do the capital raising calls, which I'll touch on a little bit, Christian gets to hear me say this all the time, and now he gets to say it. World War III breaks out, worst case scenario. What can you truly do to benefit your investors, the LPs in your deal? I can say with certainty, I could cut 90% of my team. Unfortunately, that means probably Christian's getting cut too, but 90% of my team could be let go. Me and Brandon, my business partner, our top 5 or 6 team members, we could stabilize our entire portfolio. All of my properties are within 2 hours of my house. I can drive to them, I can touch them, I can see them. Me and Brandon have done every facet of our business model ourselves. I'd go back to doing the leasing, doing the evictions, doing a lot of it myself. Brandon would go out there doing the maintenance, doing the work orders, doing the move-ins, right? We get to a very, very lean and aggressive team. I could cut out $2 million of OpEx overnight just by pulling back, reducing our team because we know exactly how to do everything. And I know which people would be critical and which wouldn't. And I could keep letting them go to make sure we keep the bank paid, we keep our investors paid, and we weather the storm. We wouldn't be doing the value add. We wouldn't be doing the CapEx stuff. We wouldn't be doing the high growth mode, but we would make sure we keep the lights on. Everybody's paid. We keep them occupied, stabilized. And then once we're through that economic event, grow in the back end. Again, that's in a World War III black sheep, black swan scenario, very unlikely to happen. But if it does, I have that plan, right? So those are the questions you should be asking the GP operators. World War III breaks out, picture the worst economic event possible. What do you do, right? How do you still hit your numbers? And I can say with absolute certainty, we would still hit our numbers. We'd still cash flow. We've built up a tremendous amount of equity as a buffer. So we're not out over our skis. We're not over levered. We have a very low LTV across the portfolio, closer to 55% only, very cash flow heavy. So in that worst case scenario, I can cut costs because I am vertically integrated, right? I'm not dependent upon other people. I would keep our key people that do it in-house, maybe outsource a little bit, keep the cheaper virtual team members offshore, and run it with the skeleton crew. To dive in a little bit even more on the case study, just because I think getting into the body tissue is important, not just talking about surface level amorphous things. When going back to speed, every week, me and my business partner Brandon, we meet on Fridays, and we ask, how can we do everything faster? And we look at first principle thinking, and it's never what is industry standard, what does our competition do? It's no, how do we do it faster? How do we do it better? And we talked about those two things in the purchase agreement. That's how those came about. Well, what if we started turning units before we even owned it? Well, what if we got the owner to only renew leases month to month so that when we take over on day one, we can get a third of the units back to start turning them, right? Because typically you close, you have to wait. You only get on average 1/12 of the units back every month, and that's the most you can turn, right? How do we do it better? We also go in then, if we don't have enough or if we're further ahead, we'll go into all the existing residents and we'll pay them. Hey, we'll give you $2,000 to move out if you don't plan on renewing and transferring into a brand new unit. This is happening whether you like it or not in 6 months. That's our business model. We turn C minus properties into B plus properties. That's what we do, right? I don't want to say we don't feel bad for the residents because we're displacing them, but we do give them their full deposit back. We give them up to $2,000 to find a new place that's going to be budget friendly with them because we're trying to improve this property. And we'll get them out and we'll get the units back and turn them even quicker. So those things are constantly top of mind. And then when we go in and actually do the work with our team, Brandon, my business partner, used to own a construction and a roofing company. This is his entire wheelhouse, but we work it and build it together. We have a morning meeting every day at 8 a.m. All of our crew teams know exactly what unit they're going to. They know exactly what part of the turn status they're in. We pre-kit and palletize everything. So everything that that unit needs is in the truck. We provide trucks and all tools to all of our team members, and it's ready to go. And when they go to that property, they know exactly what to do. The crew chief's in charge. The two rental techs below them are doing exactly what they've been taught and trained on. There's time studies that go into it. We know exactly how long it should take them to turn all the LVP floor, for them to redo the kitchen, for them to redo the bath finishes. And if they don't hit it the next morning, that next 8 a.m., we ask, right? Why are you guys behind? What happened? How do we get you caught up? What do you need? Do you need more resources? And we're constantly looking at that every single morning at 8 a.m. It's never missed. The entire team's there. It's a pretty neat thing to see. They all come in, they arrive at the shop, they gather all the equipment. We bulk purchase everything. Everything's already stocked. We already have it inventoried. If anything's running low, we already order it, right? It's never an out of stock situation. Those types of preparations take a while to build out. The SKU standardization takes a while to build out. But once you're there, it's just the efficiencies are crazy and they stack up extremely fast. So crew gets the stuff, they go to the property, they work together cohesively, typically 10-hour shifts. They come back, we figure out how much they got done, and then we build out the game plan for the next day. So every night, Brandon and our turn team are figuring out what's the next day's mission. How far do we get? What's the next day, right? It's not guesswork. It's not, well, we missed 3 days because this painter didn't show up. We have a backup for a backup for the backup, right? We do not lose days. And by doing that, we are averaging 7-day turns or less for a full turn, meaning we do all brand new LVP floor, paint, trim, cabinet, countertop, appliances, bath fixtures, all the bolt-ins in 7 days. Like that's our standard. We're trying to get to 5-day turns and targeting 72-hour turns. We have 212 man hours on average that goes into a turn. We can do that in 3 full days if we have a 3-man crew just using math and the time, right? And that's what we talk about every day. How do we get there? How can we get it even faster? So that's extremely important. And that case study is a great example. When we started out, it used to take us 45 to 60 days doing it in-house. We've always done it in-house. 2 months was normal. We were happy with that. And then we started asking why, why? How do we do it faster? And over a decade, we're now down to 7 days, trending to 5 days. And that speed and same logic, it really scales it up. And that's an entire property in less than 12 months. Again, another one, leasing. I already kind of hit on this, but to go into even more, right? Focus on this for the body tissue. Right? Alex Hormozy, if you don't follow him, you need to. He's the best business coach there is. It's applicable to every single business, especially real estate. He just started a real estate arm and overnight has $300 million of real estate. And if anyone's in the A minus class property, he's coming for you. He's got this dialed in. So we go to all of his workshops, we subscribe to all his material. We've spent almost $200,000 with his management team building out these systems. But our leasing team operates exactly like Alex Hormozi's sales team, right? We treat this like a high ticket offering because it is, right? We average from $1,000 up to $2,000 per rent per month. That's a $12,000 or $24,000 ticket that we're selling, right? So we train as such. So our sales manager does daily stand-ups every day. He does one-on-ones every other day with our team members. They role play. They do script adoption. They have to read the script until they memorize it. They go over objection handling. And we are making sure we have boots on the ground feedback instantly. And that used to be done manually with the team. Now we're doing it more and more and more with Claude. And so we have an entire AI system now. Claude literally reviews every single showing and call we do every day, whether it's the setter or leasing manager. We have an entire scoreboard framework and it's scoring every single call. It's hitting our top 10 measurements. It's looking exactly at what was followed in the script. And then on the back end, it gives us recommendations on how we can improve our script at the property level. So it's always giving us that feedback too. But then for the individual level, it's telling the leasing managers what they should have done, how they could have done it better. And how do we get better overcoming objections and asking for the sale, right? Like that's super important. Another thing is we always ask for referrals on the call. It's mandatory. You need to ask and try to get 2 referrals on every call. Referrals are organic. They're free. They're the best lead source possible. People want to live with their friends than other people they know. If they don't ask for the referral at the end, they get dinged, right? It's in the scorecard. I know it shows up. Claude will take clips. It'll show exactly what they said. I can read them real fast. That process has been super neat. Switching to virtual tours has been a massive adjustment for us. We used to do mostly in-person tours, but it's allowed us that speed to be so much faster. We try to do everything instantly. So a leasing manager calls, they're trying to do the showing right now. If they have 10 showings scheduled for tomorrow that the setters did, they're calling all 10 of them and saying, hey, can you do the showing right now? Great news. I got a showing right now. I got an opening. Can we do it right now? Can we hop on a Google Meet? It'll take 10 minutes. And they're not waiting, right? If the call is for tomorrow at 12, they say, well, what about later today at 4? I have an opening at 4, maybe 4:30, because this is not going to be available tomorrow, right? This property, this unit is going to be gone. I want to make sure this is a perfect home for you. I want to make sure you get into it. And that's how we talk every day with our leasing team, right? It's competitive. Like you have to claim it. We've built an entire custom AI widget with a webhook in Slack. When we get a new lead and a new showing, it comes in and the first leasing manager to click the button in Slack gets it, right? It is competitive, right? We show the scoreboard every day. I know how many leases were sent, how many leases were signed, how many showings were done with the show radius for every single leasing manager. They see it in real time, right? It's a scoreboard. It's tracked ruthlessly. And then on the back end, we were getting some pushbacks on not doing in-person showings. We gave them the Grand Slam offer. Hey, if you move in and you don't love it, within 7 days, you can tear your lease up. I'll give you all your money back, your deposit back. Zero cost to you, no questions asked, you can move out. That guarantee is the comfort to allow them to move in, right? And so those guarantees we think about all the time too. What can we add to overcome the most common objections we're getting? How can we give them that surety? A lot of people don't want to move in sight unseen, but the speed we operate, they have to. If they want to wait to showing on Sunday and today's Thursday, it's going to be gone, right? Our days on market is very, very few, if any. It's usually a wait list. So it's very important that we hit that guarantee and we know how to overcome that objection. And then the same token, if we have about 1 out of 100 use that, that's fine. If they don't love it, if they're not going to be a good resident, we're going to hear about it for the whole year. They're likely not going to renew. We make all of our money at time of renewal. I want them to move out. I'm completely fine with them moving out. So think through it from the business practicality side as well. Very important. Okay, so red flags. Obviously, I've talked about a lot of these things. The outsourced operations, I've hit on pretty hard. The IRR, I'm not going to get into a lot of true underwriting metrics. I can do that on another webinar. We have an entire underwriting model that we use very different than most. We've used every underwriting model under the sun. Like I said, we've underwritten 100 deals every month, not just like bar napkin underwriting, like true in our spreadsheet underwritten, and we got the exact price we'd be willing to go into the spreadsheet. So IRR is a glamorous term that is relevant for some, but for companies like us, where speed is everything, we focus way more on a return on our capital. All I care about is how quickly can I get my money back? Meaning, if I go in, we buy a property, and we used to self fund everything. Now we do have private investors in our entire fund with us. But when I go in and let's say we buy a $10 million property, we put 2 million down, that 2 million, how quickly can I refinance? And I want to make sure I get at least 2 million back. So more than 100% return on capital in 12 months or less. That's our focus. So we care more about the speed of the return on capital, the percentage return on capital than anything else. So it's a very different way we underwrite. And again, I can get into that to a different longer term webinar if a lot of people ask for it. Happy to do one-off calls too with people interested. Um, the thin operator skin. So if the operator has very little skin in the game, meaning how much money they invest in the deal, that's a huge red flag, right? We put in 50% or more. It used to be 100. It's well over 50% typically. And it's at first risk loss dollar, meaning when investors come invest with us, banks get paid first, our investors as preferred equity get paid second, and then me and Brandon as the common equity, we get paid last. We put our money where our mouth is. We're putting more money in than any other investor in every other deal. And we are the ones that are taking the loss first, meaning if we have a pullback in the market, we lose 20% of the value in the property. My money gets lost first before the investor's dime is affected from the valuation perspective. That's how we stair step it. I know a lot of operators do not, but those are questions. And if they can't answer, why not? Those are great pushback questions to ask. Why don't they have more money or skin in the game? The geographic sprawl, I again, we are very biased. We are not the norm for real estate investors, but we are hyper focused on Western Ohio. Me and Brandon are both from small tertiary markets in Western Ohio. We both did our schooling in Ohio and moved back to our hometowns. Our team's based in Western Ohio. I like to touch, see, feel every property we have. I like to invest in properties I understand, areas I know. I have zero interest investing in high growth markets like Texas, Denver, Nashville, et cetera, right? Because of those risks, right? In Ohio, I understand these markets. I know it's been undersupplied. It continues to be undersupplied. And it will be, right? It's just more glamorous and sexy to build new in Austin, Texas than a suburb of Dayton, Ohio. Because construction costs are the same no matter where you are. You're the exact same cost depending upon types of finishes. You're at 250,000 up to $500,000 per unit. And in Austin, Texas, you can charge 4,500 a month for rent, and in Dayton, you can charge 2,500 for the exact same product. So I understand why the developers and new development goes to these markets, but that's why I love the markets that are undersupplied. I don't love saying this because I don't want everyone to flood to Ohio, but Ohio is a gold mine, right? It is undersupplied, is a great state. Most people know it's the seventh most populous state in the country. It's basically the Silicon Valley of the Midwest. There is a flood of growth. There are a lot of counties that are predicting 20, 30, 40% increases in population in the counties you've never even heard of. So things like that are super important to me. And when you see an operator or GP that does a syndication in Denver, then does one in Tampa, like how can they even have a pulse on those markets or get there, right? Something goes wrong. I get in my car, I'm at the property in 20 minutes or an hour, et cetera. They got to get on a plane, right? So geographic sprawl, super important question to ask. Over leverage, the LTV blended, knowing that, and then knowing if it's a floating rate interest rate or not, super important, right? And look at their past deals and their past fund and where their portfolio is and how the entire big picture comes together. With us, we waited 8.5 years to take on private capital because I wanted to build up that much equity and track record to remove the risk for our investors so that we were never over leveraged. Because when I was a practicing attorney, all my clients that went bankrupt, belly up, the deals went bad, is because they were over levered, right? Or they had a variable floating interest rate debt. They had a great short-term loan. They went in and thought they're going to have a bridge loan rolled into a long-term, and interest rates flipped, or just wasn't, the opportunity wasn't there. When we invest and when we get loans, we will only get regional banks and credit union loans as a purchase and capex loan going in. minimum 5-year fixed interest rate, typically up to 7 years, 25-year, 30-year term, amortization matches. We have no prepayment penalty. That is critical. I have all the flexibility in the world. All my newer loans now have zero prepayment penalty. I can do anything I want with them, no penalty. I can refinance them. I can pay them off in full, etc. Super, super important. Our interest rates are typically 6.5% or lower. And then we try to refinance that out into long-term, either a refinance into a long-term loan with the current bank or into agency debt. The agency, we're getting a 10-year fixed rate, 6% or less. We're getting another 3 years, no prepayment penalty. We try to argue against if there is, we make sure it's a staired step prepayment of like 222, 111. We're not doing any kind of crazy buyouts. And we're usually doing a buy down to get even lower interest rate. So in our entire portfolio of all of our loans, our shortest term is 5 years and our longest is 10. And we're in the blend between there. We have zero floating rates, zero variable rates, super important. And we're very under levered at about 55% across the board. Fee stacking. Won't charge any fees. We have a 5% property management fee. We have to charge that to break even all of our sister companies. That's all it is there for, is just to cover some overage there. It's not charged against our investors. It's not charged against the fund. And we don't charge anything else. No acquisition fee, no refinance fee, no disposition fee, no other asset management fees. We don't need to make money that way. A lot of the GP syndicators, you'll see they're charging fees like crazy because that's how they live, right? And I get it. And I'm not discrediting other operators. There's a ton of really good operators out there. There's operators I'd gladly invest my money with that do charge these fees. So it's worth it, but you have to make sure you know what you're getting for it, right? If they do everything in-house, way more justified, right? They have more overhead. They're doing more of the work. They're taking on more of the risk. They're cost saving for you. So make sure you understand the fee stacking behind it. Again, I believe this spreadsheet will get sent out to everybody, or this slide deck will be sent out to everybody that opts in with some questions to ask, right? And I've already hit some of these, but these are just ones you can walk in quickly. Who owns the operations? What's outsourced? How much of the money they have in the deal? Where do you sit in the capital stack? And how much equity is below you? Super, super important. Most people don't know. They're the last dollar in and they're the first dollar to lose money, right? Like you need to understand that. So with us, you're the last dollar in, but you're ahead of me and Brandon, right? That's super important. What's the LTV? There's any floating debt rate. Understand the terms of the notes that they already have on the property or future refinance terms they've had in the past. That's super critical that they can talk to those points. What fees? We just went over that. What's the liquidity? When can you get your money out? This is a super, super important thing to know. Most investments are not liquid, right? You are locked in. Some operators have some pretty unique ways to get liquidity back. Some are all, which I really like. Liquidity to me is super important. It's worth getting a slightly less return for more liquidity. With us, after the first year, you can get some or all your money back with 90 days notice. No questions asked. It's always available. That liquidity option is very rare. You usually only see it in debt funds, not in equity investments like us. Always understand where your liquidity off ramp is. Have they ever missed or paused an investor payment? Super important question. Make sure you understand the track record of all their last deals. We've never missed or paused a payment ever. And that should be the case for most. Some have, and they have great justifications for it, but just make sure you understand the reason why. And then again, the black swan event. Walk me through the worst case scenario. What exactly happens? What are the mechanisms? And then point me to where in the documents it says this, right? In our operating agreement, in our PPM, very simple. I'll tell you, this is exactly where it says you're ahead of me in the capital stack. And you can stress test that with your attorney. Again, black swan event, we already talked about this. Very, very important question to ask. Again, this is how ours is structured. Again, most are not, but make sure you understand where in the capital stack you are. That position really, really matters. And then the tax side of it, right? This is super important too. Some operators are very good at telling you the tax stack of benefits they're giving you. Others hide it, right? Because either they don't understand it or they're not offering it. Two big ones is either you can spit out depreciation or you can give what's called a return of capital tax treatment. Very rare. Not a lot of people do this. We've been noodling over our structure for 8 years. We got one of the best real estate tax advisors in the country to help us. It literally took about a year to develop this structure. When we give out our distributions, we pay a fixed annual 12% return. For the first 8 years and through year nine, you pay no tax on the 12%. So you invest $100,000, we pay you out that 12% return every single year. We pay you $12,000 every year. You pay no tax on that because it's treated as a return of capital tax distribution first. So you get to take your entire capital back, basically bring your capital count down to zero before you start seeing gains. And only in year nine does that happen when your capital count gets brought down to zero. I won't go into too much the detail, the mechanisms of that, but this allows it to be an effective return of 15 to 19%. So if you get 12% back every year, and that's an after-tax equivalent return, meaning you get to keep the full 12,000, spend it, redeploy it, etc., and you pay no tax on that until you get all your money back. If you opt out earlier or if you continue to hold long term until you year nine, you're paying that tax. So if you get 12% after tax, it's like getting a 15 to 19% return in another vehicle comparing apples to apples. So it's super important you understand the tax benefits of the distributions you're getting as well. So very, very important questions. If the operators, GPs can't tell you the tax benefits, that's a huge red flag. I know these in and out because it's super important to our business model. And so any good GP or operator should know them as well. Kind of the framework, again, we've been rolling into all this. Ask the questions right. The vertically integrated one is super important, and not just amorphous. Like, yeah, we do our own property management. Get into it. What does that involve? Are you doing maintenance? Are you doing leasing? Are you doing the construction? If you're doing the leasing, how's that look? How do you guys handle your leads? How do you guys handle your leasing, right? You don't need to know everything about them, but if you can see they're passionate about their operations, like I'm hoping you kind of see my passion, that's a really good green flag, right? Like if they're passionate about operations, they really care about how the business is going to make money. Super, super important. Scan for red flags, outsourcing, IRR chasing, how much skin they have in the game, the location sprawl, how levered they are, the fees. Run these 8 questions I put out before, stress test the downside, what's the black swan event, and then check your position. Where are you in the capital stack? Are you the last person in, first one to lose money? Are you rescue capital? Are you some second offering of pref equity that comes in a weird spot in the capital stack? Super important things to know. Um, Again, if that framework gets applied well, a lot of really cool things can happen. We're starting to grow pretty quickly. Our goal is to buy 1,000 units a year starting next year. Pretty ambitious. We used to have a lot of other companies. We did a lot of other things. We've since sold them all off successfully to go all in on our value add model, which is all coming together really nicely right now. So it's working, right? And it's all a function of bringing vertically integrated operations in-house. So super, super important. But let's open up some questions. And again, Christian, capital raising manager, he knows this as well as I do. Love to have calls. Happy to talk to you about our investment opportunity and not just ours. If you have other deals you want a second opinion on, send them to us, right? We want to compare things. We want to point out potential red flags, right? I'm happy to do that. For the last 10 plus years, I've had great mentors. I've had people give me tons of time, analyze my deals, give me feedback for free, right? And we're always happy to give it back as well, whether it's with us or somebody else. I want to make sure your capital is protected.
Justin, thank you so much for being on today. We do have a few questions in the chat here. The first is from Jared McLiver. His question is, how come you are doing this 7 a year while you target 3 per year?
Yeah, so this year we've stacked up a lot of refinance capital. So we have a lot more capital than traditionally we've had. And we've bought a couple smaller properties. We're trying to target larger 200 unit communities. Where in the 7, we have a 36 unit, 248 units, a 53 unit. So some of them have been smaller. So I kind of view them as 3 like large properties is what we're targeting. And we're growing, right? That used to be we'd buy 2 a year, now 3 a year, and then it's going to be 4 a year, then 5 a year. But unit count and unit type and size matter within there as well. But this year we've had tremendous deal flow and we've had a lot of capital from successful refinances come back to us to reinvest.
Thank you for that. And another question from TC. What are some of the key items to look at on an OM? They've invested in some deals with some shiny OMs and they've lost money.
Yeah, so what I just alluded to doesn't jump out on an OM, right? They don't hide the fun details on the cover page, right? You can't get it in a one pager. Like I love a really good one pager that explains the deal mechanisms, what's their value proposition, why them, right? And a big part of it is how they found the deal, right? Like how the deal came about. And then the economic terms of how much skin in the game they have, the location of it, their track record in that market. Those things can jump off in a one pager. But in an OM, it's going to be the questions you ask, right? You can't get into the nitty gritty of the operational details in a paragraph, right? So unfortunately, an OM is great to see an investment at kind of the surface level, just to see if you have any interest. And then the most important thing is to hop on a call with them, get on their webinar, and stress test them through these 8 questions.
Thank you. And we have another question here. How are you calculating the returns on renovating in 6 months versus 3 years with cash flow keeping the basis down? That is from NAC.
Yeah, great question. So we look at it as a return on CapEx dollars, meaning if I buy a $10 million apartment with a $2 million CapEx budget, I want to be able to get usually 3 to 1 return on my dollars. So improve the value by $6 million. So we put two in, we get 6 million on the back end. If I can keep a 3 to 1 ratio, regardless of the timeline, 3 years or 6 months, we can be successful and we do really well from an ROI standpoint. That's kind of our baseline number. But the beauty of that, right, is the time value of money. So if we can get that in 3 years, or we can get that same return in 6 months, right, it's exponentially better because then I could take that capital and use it again in the same cycle, right? So it's all about how many cycles can we use it. And so we used to think of a 2 year cycle. Then we thought of a 1 year cycle. Now we're thinking of less than 1 year cycle. So I can use my same dollar more than one time in a 12-month period. That is infinitely better. And that is the business thesis we're working on right now in detail. Honestly, our hardest thing is getting the banks to understand how we can do the renovation and value add in less than 12 months and not be constrained to an LTC loan to cost versus an LTV loan to value refinance valuation they use. So when you go that fast, right, you have other roadblocks to get over, but our relationships allow us to get over that. But I know it's not directly answering your question, but that's how we think about it from the capital and the return of cash standpoint.
This is Greg here. He's just saying that he's very excited that you guys are investing in Toledo. Looks like he grew up in Sylvania, has a lot of contacts in Ohio. Christian, a lot has been discussed about a Black Swan event. Can you explain your experience in occupancy rates during COVID?
Yeah, so COVID is the question we get the most, which is ironic because we had our best leasing occupancy during COVID, right? Everybody paid their rent first, right? It's the most important thing to pay, and nobody wanted to move or get displaced. The government backstopped a lot of renters, and then in the markets we target, we are the only option for really good workforce housing. Meaning, if you want to live in a BB plus community that has nicer finishes, that has an operator that takes care of the property, that takes care of work orders, it's not a community where there's a lot of drug activity, violence, etc. There's not a ton of options. So we had our current base that stayed during COVID because they couldn't go anywhere else. But we also had a lot of white collar workers who couldn't afford their A-class property, who couldn't afford their home, that were also leads now for our property. So we had more volume of lead flow and more optionality for our tenant base than less during COVID. So that's what I really like about that C plus, B minus, B class property is in good times and in bad, there is high demand for this property type. And so I don't want to say it's recession proof, but we've not seen any economic event in the last 10 years that have massively impacted our lead flow.
And we've got one more question here from NAC. Can you expand on the 3 to 1 return on dollars? How is that calculated?
Yeah, so it's truly a CapEx function. So if we're getting so we always do a purchase loan and a CapEx loan. So typically 75% purchase loan, 75% LTV CapEx loan. Let's say, it's a $10 million purchase, $2 million CapEx. We're putting 10 million or 10 million in the purchase. We're putting 2 million in the CapEx. When that gets done, that 2 million of CapEx, I want to be able to get an appraised value of 6 million for that. So the property appraised at 16 million minimum, right? So I buy it for 10, I put 2 and it's worth 16. So the amount of money I put in the CapEx, the 2, the return is the valuation I get on the appraisal side, which is the 16. So increasing the value by 6, that 3 to 1 return was really attractive when it took us 30 months to turn it. Super attractive at 2 years, very attractive at 18 months, more attractive at a year, even more attractive at less than 12 months to turn a property, right? So that speed is very important. But we've had other properties where we've had it be 8-to-1 return on our CapEx, right? We put 10,000 in a unit, we get 80,000 on the back end, right? Those are few and far between bigger home runs, but we try to hit that 3-to-1 sweet spot always.
Justin, Christian, thank you so much for being here. Any last thoughts for the audience before we break for the day?
Christian, I know I didn't let you talk much. Anything I missed or could better clarify that we like to say that I just jumped over?
No, the most common question we get is that black swan event and how our investors are protected. It's really the common equity that you hold, and also just the liquidity features that we have for the fund. But I also wanted to say that I met a lot of investors, operators, GPs, LPs since the best ever conference earlier this year, and I've had a lot of great conversations with many of you, and you've become investors of ours. So we're grateful for your trust and your partnership, and I look forward to meeting many more of you.
Yeah, I echo that sentiment, AJ. Nothing else to add.
Awesome. Justin, Christian, thank you so much. And thank you, best ever audience, for joining us today. We will see you guys next time.
Thanks a lot.